Hello, in this video, I'm going to discuss monetary policy. So, like fiscal policy, basically, fiscal policy is the use of government spending and taxes to influence the economy. With the same token, in the monetary policy, we are dealing with the management of the money supply and interest rates by the country's central bank to influence the economy. And by influence the economy, I mean to tackle primarily the problem of inflation. So there are two methods, basically, or two monetary tools. One is targeting the money supply. So central bank can target the money supply, controls the money supply, and impact the real GDP. Or central bank can also directly target overnight rate as well. So there are two methods to control money supply. One is there are other methods as well: open market operation and switching government deposits. So I'm not going to concentrate more on the factors that actually responsible or used to control money supply. I'm directly going to discuss what would happen when central bank increases the money supply and how does it impact investment, real GDP, and prices. So this is what we call like expansionary counter-cyclical fiscal policy. We have same expansionary monetary policy. That is, if the economy is experiencing a recessionary gap, and this is the diagram for a recessionary gap, and we are using money supply. That is, central bank is targeting money supply. So central bank actually, in this case, increases the money supply and then see what would happen. So when central bank or Bank of Canada increases the money supply through open market operation, let's say, then the aggregate demand curve shifts rightward as shown in this diagram. And you can see there's no gap. That is, the problem of unemployment can be solved by shifting aggregate demand curve through the increase in money supply. But notice in this diagram, you don't see money supply anywhere in the diagram. On the vertical axis, we have price level. On the horizontal axis, we have real Y, I mean real GDP, and aggregate demand is C plus I plus G plus exports minus imports. That is consumption plus gross investments plus government expenditures plus exports minus imports. There's no money supply. Then how come this money supply is shifting aggregate demand if there's no money supply in the aggregate demand equation? So let me show you the whole process, how increase in money supply will actually shift the aggregate demand curve. As you can see, even in this slide, I have shown here, when central bank increases money supply, it will decrease interest rate, in turn increase investment, and then investment is a component of aggregate demand, that is gross investment. So aggregate demand curve will shift rightward. Now let me show you the 4 diagrams and show the whole working or the whole adjustment process. See what is happening actually. So initially, central bank increases money supply through open market operation, through these two methods, open market operation or switching government deposits. By open market operation, I mean central bank actually they buy and sell bonds in the secondary bond market. So they sell bonds and they buy bonds. So if central bank is selling bonds, it means now people have less money. So the bank's funds will decrease, commercial bank funds or deposits will decrease because people are buying bonds from the central bank. Similarly, when central bank, buy bonds from the secondary bond market, then basically the central bank is squeezing the supply of, or increasing the supply of money. Why? Because central bank is buying bonds. So central bank has more bonds and the more cash with the people. So money supply will increase. So this is how basically central banks influence the supply of money, or increase or decrease the supply of money. So suppose the supply of money increases from MS1 to MS2. So this is the initial diagram. So this is the diagram for money market diagram. So in the money market, you can see when money supply increases, interest rate decreases. This decrease in interest rate will give incentive to investors to borrow money for investment. So when interest rate decreases, investment will increase. So investors are going to invest more because of lower interest rate, because cost of borrowing is lower. Then you have two impacts in two different diagrams, and these two bottom diagrams are saying the same, exactly same thing. So when investment increases, in this diagram, aggregate demand is increasing. So aggregate demand shifts to the right, and you can see there's no recessionary gap anymore, because more real GDP, higher real GDP, less unemployment. So the problem of unemployment is solved. This is aggregate demand, aggregate supply model. But we can show the exact same thing using aggregate expenditures model. So when investment increases, the aggregate expenditure curve will shift upward like this. And now you are here, which is exactly equal to full employment. So the gap, recessionary gap, is eliminated through expansionary monetary policy. Then we have exactly the same way contractionary monetary policy. So when we have inflationary gap, and central bank is supposed targeting money supply, then the policy would be to decrease money supply. If you decrease money supply, you means central bank. This decrease in money supply will increase interest rate, will discourage investment, and therefore aggregate demand will decrease, and the whole aggregate demand curve shifts leftward like this. The problem, that is, this gap is closed, is eliminated through contractionary monetary policy. If you want to see the four diagrams, this would be like this. That is exactly opposite. So the monetary policy would be to decrease money supply directly through open market operation, and money supply decrease will actually lead to increase in interest rate. This increase in interest rate will decrease investment, and this decreased investment will shift the aggregate demand curve to the left and aggregate expenditure curve to the down, and you can see both gaps are eliminated. So this is money supply targeting. But I told you in Canada, Bank of Canada does not target money supply. Bank of Canada targets interest rate directly, because if you are targeting money supply, technically you want to impact this interest rate. So why not directly control this interest rate rather than controlling interest rate through money supply? Because central bank or Bank of Canada does not know exactly the location of the money for demand curve. It's very difficult to predict. So even if the supply of money, that is money supply, is decreasing, rate of interest might not increase that much, because it all depends on the slope or elasticity of the money demand curve. So these are some of the issues with targeting money supply that are given here. So Bank of Canada cannot control the creation of loans by commercial banks. So even if central bank or Bank of Canada gives more money to commercial banks, it does not guarantee that commercial banks will loan out this money, because commercial banks might not find credible creditors or may not find customers. So it's not always the case, or it's not always certain. Second, Bank of Canada cannot know about demand for money and therefore cannot predict the impact of the money supply. The Bank of Canada consequently began to target interest rate directly as the main policy variable and restricted the role in controlling inflation rates. So the primary purpose of Bank of Canada in Canada is to control inflation using or targeting, interest rates. How this is going to achieve? Let's take this example. So first, you have to understand what is overnight interest rate, and in short, I write OIR. OIR means overnight interest rate. So this is the rate not where you borrow money from banks. This is the rate at which commercial banks charge one another on overnight loans. So when commercial banks borrow money from another bank on overnight basis, they pay this interest rate, that is overnight interest rate. And this rate is controlled and dictated by central bank, that is in our case Bank of Canada. This rate is also called policy rate. So the key OIR, that is overnight interest rate, the key policy interest rate is the midpoint of the bank's 50 basis point operating band before 2020 floor system. Now it is a 25 basis point operating band. The policy rate changes 8 times in a year. So don't get confused and worried. By 50 basis point or by 25 basis point, I simply mean that the gap between the two interest rate before 2020 was 0.5%. 50 basis means 0.5%, and 25 basis means 0.25, that is quarter percentage. Let's discuss this definitions. So this is in the middle, we have target for OIR. So this is the policy rate, OIR. This is the policy rate. Let's say this is 4.5%. So, and the Bank of Canada announces this rate of interest 8 times in a year, fixed dates. I'll show you those dates as well. So suppose if the policy rate is 4.5%, then the upper limit is the commercial banks, what we call, which we call bank rate. So bank rate must be 0.25 above the policy rate. Always, this is the rule. So you have 4.75 because you added 0.25 to 4.5%, 4.75. This is called bank rate. What is bank rate? Bank rate is when commercial banks borrow from Bank of Canada. So when commercial banks borrow from Bank of Canada charges this bank rate, that is 4.75. So if you want to borrow from banks, commercial banks will never lend you money less than 4.75%. Why? Because if they are borrowing from central bank at this rate, it is not profitable for them to give you the same money at the same rate. They must charge you slightly higher than 4.75%. Now, before 2020, the bankers' deposit rate was 0.25 less, that is 4.25%. So this rate before 2020, it was this 4.5. Before 2020, it was 4.25. So that the difference between 4.25 and 4.75 is 0.5%. But after 2020, we have only 25 basis point operating band. So this is the operating band. This is called operating band. So this is 0.25 means the banker's deposit rate must also be the same as policy rate, that is 4.5%. And now you can see this 4.5% from here, this 4.5% to this 4.7%. Look at the difference is only 0.25. That's why we call it 25 basis point operating band. What is bankers deposit rate? This is the lower limit, and this is when commercial banks lend to Bank of Canada. So when commercial bank, keep their money with Bank of Canada, then Bank of Canada pays this rate, that is 4.5%. Okay. Now, you must be thinking that I'm talking about policy rate, overnight interest rate, but what about other rates, mortgage rates, prime rates? If you want to buy a car, then you pay interest on car loans. There are so many different types of interest rate, interest on your credit card bills. So there are different interest rates. So you must be surprised that all interest rates are interrelated. If policy rate increases through Bank of Canada announcement, all other interest rates will also increase. And if policy rate decreases, all other interest rates will also decrease. Okay, so this is the rule. Now, these are the 8 times in a year: 24 Jan, 6 March, 10 April, 5th June, 24, 4, 23rd, and 11. On these 8 pre-specified dates, Bank of Canada announces policy rate decision, right? So they might say that they are going to increase policy rate. They might say they are going to decrease policy rate. And they also might say that there's no change in interest rates or policy rate, that is overnight interest rate. So this is the rule, not rule actually, but this is, it varies from banks to banks. So commercial banks charge their best customers a prime rate. And if the bank rate is 5.25, then prime rate must be higher than bank rate. Recently, Bank of Canada has reduced policy rate. And as a result, the prime rate has also gone down. It was 7.2% a year ago. Now it is around only 5% or 5.5%. Why? Because the policy rate has gone down. Similarly, mortgage rate is less than prime rate. Similarly, personal line of credit is greater than mortgage rate. Rates on saving is less than bank rate. So all these rates are, of course, not 100% equal, but they are moving with the change in policy rate. So this is how Bank of Canada or any central bank controls inflation. So this is anti-inflationary monetary policy. So when you have inflation in the country, that is when the economy is experiencing an inflationary gap, what would happen? The Bank of Canada will increase policy rate. So there's an increase in policy rate. And by policy rate, I mean overnight interest rate. This increase in policy rate will increase all other interest rate as well. That will discourage investment, because investors are now going to invest by borrowing money because it costs them more. And also exports as well. So increase in policy rate will decrease our export. How? Because when interest rates in Canada is increasing, then foreigners, let's say US investors, are going to invest in Canada. Why? Because so that they can earn higher interest rate. I'm not saying they are borrowing money, they're investing in Canada. So if they buy, GICs, guaranteed investment certificates, they're going to get higher interest. How come they can invest in Canada? They need Canadian currency, Canadian dollars. So they have to go to the foreign exchange market and they buy Canadian dollars. It means the demand for Canadian dollars will increase. That will increase the price of Canadian dollar. So Canadian dollar would appreciate. When Canadian dollar will appreciate, your exports would be expensive in United States, that is in terms of US dollars. So the price is not changing at all. There's no change in price level. But because your currency is appreciating, so when you convert the price in dollars in Canadian dollar into US dollar, it will be much higher. So US customers are not going to buy our products because it is more expensive, because of this appreciation of our currency. So exports will decrease. So increase in policy rate will decrease both investment and export. And you know that investment and exports are two important components of aggregate demand. So aggregate demand will shift to the left. That is, we have lower demand in the country. What would happen? Low inflation. Cost of servicing debt increases because of high interest rate. Because government also borrows money to make certain expenditures. So if rate of interest is increasing, then government will have to pay higher interest rate on those borrowing. So that is one caveat, one problem. So let's see, it says draw diagram. Let's say this. So this is the diagram. So you can see here that the economy is in the inflation, in an inflationary gap situation. And when policy rate increases, that when Bank of Canada increases policy rate, then export and investment will decrease through interest rate. And the aggregate demand curve, this green AD1 curve, will shift to the left and intersects exactly at the full employment level of output, that is red AD2 line, and there is no gap in this case. So this is exactly opposite, but normally I told you earlier that Bank of Canada is primarily concerned with anti-inflationary policies, that is control inflation. But in case of unemployment, the policy would be exactly opposite. So if there's unemployment in the country right now, we have that is in 2023, we have now lower inflation and higher unemployment. So Bank of Canada has been continuously for the third time decreasing policy rate. So when policy rate decreases, exactly opposite happens. That is, investment increases and export also increases. Why? Because now Canadians are investing in US because of very low interest rate here in financial assets. So we now would rather keep our money with US banks so that I can earn relatively higher interest rate. I'm assuming that interest rate in Canada is higher than interest rate in US is higher than in Canada. So our currency depreciates because if we want to invest in US, we need US currency, and therefore the demand for US currency will increase. US currency will appreciate, Canadian dollar depreciates. When your dollar depreciates, yes, your export will increase and your investment will increase. That will increase employment in the country. So we have low unemployment rate. And this is the relevant diagram. So exactly looks similar, but it's different. Now you have a recessionary gap situation. So green, original aggregate supply and aggregate demand curve. And because of the decrease in overnight interest rate, investment and export both increase, and you can see the aggregate demand shifts to the right and intersecting at a point where long run at let me mark it at here. So so this is a new equilibrium, which is also exactly at FY or YFE, that is real GDP at full employment. Okay, so that's all as far as monetary policy is concerned. Thank you.